Ladies and gentlemen, our final session of the day is in the form of another panel, and once again, I think it's best if I just hand over to Caroline.
Thank you, Stephen. Good afternoon, everybody. My name is Caroline Bradley, a Senior Advisor in the Banking and Insurance Division of the GFSC. As you are aware, the overall theme for this year's presentations was Brexit, Innovation and International Standards, and we propose to address those three topics within this session. We have an expert panel here today who will give us the benefit of their views on a number of issues which are relevant for the insurance industry and for Guernsey in particular. There will be an opportunity at the end of the session for you to put your own questions to the panel, but if you do have any burning issues to raise as we go along, then please do raise your hand and we have a roving microphone available. So our panellists today are Andrew Bully. He joined Deloitte as a partner in the EMEA Centre for Regulatory Strategy in October 2016 from the Bank of England, where he was most recently the Director of Life Insurance Supervision. He's also previously been a UK voting member of the Board of Supervisors of EIOPA, and in a career with the Bank of England and Financial Services Authority stretching over 27 years, he's held senior roles in the supervision of life and general insurers, the London wholesale insurance underwriting and broking markets, retail and investment banks, asset managers and IFAs. Andy Smart is a non-executive director of Generali Worldwide Insurance Company here in Guernsey and non-executive chairman of Generali Pan-Europe in Ireland. He previously had a long career within Zurich Insurance Company, holding senior positions such as Chief Risk Officer and Head of Governance for the Global Life Division. And he's also a director of Openwork, which is one of the largest financial advice networks in the UK. Jeremy hopefully needs little introduction. He's the director of the Banking and Insurance Division at the GFSC. So let's start with Brexit. Yesterday we heard from Deputy Trott about the Guernsey government's perspective on Brexit, on the importance of preserving current relationships whilst exploring new opportunities for Guernsey's finance industry. Today we want to focus more specifically on the insurance industry and the Guernsey insurance industry. And we've already seen, for example, the UK targeting traditionally offshore markets such as ILS, and there's been speculation as to whether the UK will take the opportunity to rethink its approach to Solvency II. So we're wondering what will Guernsey's relationship with the UK look like following Brexit, and what does that mean for the Guernsey insurance sector? So I'd like to ask the panel firstly, where do they think Brexit will take UK insurance regulation? Andrew, would you like to go first on that one?
Yes, thank you for that. So really this boils down to what is the UK's attitude now towards Solvency II, and the separate question of how far it'll have to maintain broad equivalence with the continent in terms of mutual recognition or whatever transitional arrangements eventually take over. So I think the real question is, what is the UK's attitude towards Solvency II now? And I think, first of all, we should remember that the UK was probably the strongest proponent of Solvency II in the negotiations of some years ago. Why was that? Well, it was seen as a way of safeguarding what we considered to be a very successful capital regime, the ICAS regime, and preserving its key elements, in particular defending policyholder interest to a 99.5% safeguard standard, and also allowing firms to model their own risks and to reflect that in their own capital judgments with the regulator's approval. Those were the two key tenets of the ICAS regime which the UK wanted to carry over into Solvency II. And I have to say that very largely did succeed in doing so. And I think the delivery of Solvency II in what is one of Western Europe's largest markets, most complex markets, most model-intensive insurance markets, I think was a fantastic achievement for both firms and regulators alike. However, it's not been seamless. Solvency II, for what is a very arcane technical directive in many ways, it excites strong passions from different quarters, from different perspectives. And I think the UK vision of Solvency II ran into two different problems in Europe. I think, firstly, the UK's preference for judgmental supervision, for tactical discretion for supervisors, was not altogether in keeping with the continental preference for more codified, rules-based regimes. And I think secondly, and this is really a problem which crystallised around the matching adjustment, the UK has always taken the view that given insurers illiquid balance sheets, it is reasonable for them to be able to capitalise the illiquidity premium, provided that's done on a prudent basis and doesn't include default risk. And frankly, which therefore means that you allow a certain risk premium above the risk-free rate. That was not actually a strong view in Europe. A much stronger view in Europe was that actually for insurance prudential reasons, you should just take the risk-free rate. And as a result, we had a somewhat strained compromise called the matching adjustment, which, while it does allow a lot of liquidity premium in the system, does also constrain both firms and regulators with some very tight rules around eligibility. And I think this has caused a lot of the practical friction around the implementation of Solvency II. Now, we've had the UK Parliament's Treasury Select Committee has just reported on the implementation of Solvency II. It's made a number of very challenging points. But I think if you set aside some of the politics of this, I think there is actually, particularly if you listen also to what the regulators said to the committee during the evidence sessions, there is actually quite a reasonable consensus around how Solvency II could be changed. Particularly around introducing more judgmental, more flexible interpretations around the matching adjustment. And I think on the risk margin, which was perhaps the main big addition of Solvency II, this further layer of prudence, which was not in the ICAS regime, and which has proved heavily pro-cyclical because of its extreme interest rate sensitivity, I think a pretty strong consensus that should be reformed. And we at Deloitte expect that the Bank of England probably to take forward its own reform of this if it can't get in Europe in the next couple of years what it wants in this area. So I think there is a consensus around changing Solvency II, but I think equally there is a consensus that having come this far, having sunk a huge amount of cost into this regime, and actually having preserved the essentials of the ICAS regime, that this is not something that should be junked, but it should be reformed. But I would just say finally to firms, be a little bit careful about what you wish for, because Solvency II does build in a lot of quite tight constraints upon the regulators as well as upon firms. And I think if you move to a more flexible judgmental system, that might also bring greater regulatory discretion in some areas, particularly in the approval of models. I have heard Sam Woods in particular say that ideally he would like to see more of a banking type approach to model approval, where there's, rather than a whole balance sheet test and standards driven approach, more individual add-ons agreed by the supervisors, which might go against the preference of the insurance sector.
Thank you, Andrew. Jeremy or Andy, would you like to add any comments?
From a sort of practitioner perspective, I suppose, although I'm no longer on the board of a UK insurer, I agree entirely with what Andrew has said. But you know, if you are a purely domestic UK insurer, yes, sure, you may want to see some of these things addressed. If you are, however, a UK subsidiary of a European group, to be honest, your group will, as we know, exercise influence over its subsidiaries, and they will be saying, we want, one size fits all. We want a single approach. As Andrew said, the UK industry has invested since 2003 in, ICAS and then Solvency II. They've got a lot of other market challenges to face, and there's only so much resource to go around. And I wouldn't think this is at the top of many European boards' agendas, to be honest. I think there's more a question, of course, with Britain coming out of the EU. Are they going to lose the influence that they might have had on the inside of the tent to make some of these changes? I don't make, obviously, a political point, just one-off fact.
Yeah, I would add. I mean, I don't disagree with anything being said, but I think the future is really rather dark. It's difficult to know what's going to happen here because we don't know what the transitionals for insurance are going to look like, if there are any. Sure, the UK and certainly the PRA will want to remain equivalent, but equivalence doesn't give you passporting rights. So we also know from the Treasury Select Committee that although the PRA and so are keen to carry on with Solvency II, there are groups within the United Kingdom who are talking about a more UK version of Solvency II. We don't quite know what that is, but there's enough stuff around Solvency II, enough concern for that possibly to take place, perhaps with the smaller rather than the bigger firms. Sure, the Europeans have raised the issues. They know Solvency II need to be evolved, but they're going to evolve it without the UK being in the room. And the UK is going to be evolving it, on their own. So what is this, where are we going here? I think it's very, very unclear if I was sitting in the UK at the moment.
Okay. And then focusing more on Guernsey then, Jeremy, what do you see as the implications of Brexit for the Guernsey insurance sector?
I think it's mixed. I mean, on the one hand, and we've already had referrals to this, the new PCC legislation in the UK, that's basically our legislation for ILS. And I think a lot of people have seen that as a threat, possibly mitigated by the hope that the PRA will take so long to actually authorize something, it'll be too late, and we're much faster at that. And also by the fact the UK seems to have simply forgotten to replicate ICC legislation. I'm not so sure on that. I think, given where the UK is, they will seriously start to push the alternative ILS area. And to be fair, they're in a very good position to do that, although, again, there are reader crosses to equivalence there. I think what we need to do there is to think about our strategy. So PCC, ILS, it also links longevity. There are capital market instruments, there are swaps. I think we might want to think how we could possibly link with the UK to grow this market very considerably. And I have to say, I haven't seen the industry here really trying to do that at the moment. I mean, I think other areas create opportunities for us now that the UK is going its own way. So compulsory, particularly motor insurance, but currently sort of out of that. Perhaps we could start to do that, and there are some foundations for that. And there are other areas where we've always been able to do this, but perhaps the UK will be a bit more interested in a limited amount of life. And also, we could potentially do more general intermediary work through the internet into the UK. So I think actually there are all sorts of opportunities there. The only sort of absolute requirement is that if we are going to do more in the UK, even if it's relatively small for the UK, they're going to look at us and say, do we want them here? So I think both the industry and the regulator have got to hit pretty high standards to grow this business.
Thank you, Jeremy. Are there any questions or burning views from the audience on Brexit before we move on to talk about international standards? Okay, so let's talk then about...
This gentleman here.
Oh, sorry. Martin, hi.
Thanks, Caroline. Just a quick one on Brexit, which you haven't really discussed yet. One of the historical features of Guernsey was that it was quite instrumental back in the early days in terms of developing the Maltese insurance market, exporting knowledge in terms of knowledge about the laws, PCC legislation. Quite a lot of the practitioners in Guernsey moved both clients and staff down to Malta to develop that market. That obviously is a market that is going to remain in Europe and has a good connection with Guernsey. Isn't there an opportunity to potentially work closer with Malta to perhaps develop a kind of preferred partner in relation to post-Brexit European trade?
It's an interesting question. I think actually because Malta has its own political problems, so I think potential licensees are looking at us and looking at Malta there potentially as competitors. And I think I'd say we've got a better institutional offering than Malta. But I largely agree with you there, Martin. I think also that Malta can do different things to us because they will be continually in the EU and we won't. And there are some firms that will want to be in Malta to do general insurance and ones that will want to do captives here, and they may want to do both. potentially, yes. I think we, again, a bit like the UK, it could be more of a collaborative offering. But I think the push there has got to come from the industry. We have good relations with many regulators, but that's an economic proposition, I think.
Thank you. Interesting question. So now then, if we move on to consider international standards, and we heard yesterday from Victoria's supporter from the IIS speaking generally about the importance of financial regulation in supporting economic growth. And she then spoke more specifically about the work of the IIS and the development of the insurance capital standard, which will apply to internationally active insurance groups. There's historically been difficulty in developing this due to differences between the US and European solvency frameworks. However, a unified path to convergence of an ICS has recently been agreed, but it will involve a longer monitoring period. So my question to the panel is, do you think the insurance capital standard will happen, and if so, what might it look like? Andrew, can I start with you?
Thank you. Yes, so we had Victoria here yesterday. It was very interesting to hear her talk about this. I think she said, I actually wrote it down, it was very, very difficult, was her phrase, and I wouldn't disagree with that. I'm going to give a slightly politician's answer to this, if I may, which is that I think the real question is whether the standard will be a meaningful one. I'm pretty confident there will be a standard of sorts, but I think the issue is, will it facilitate meaningful cross-border comparisons? Will it achieve the sort of objectives which one traditionally sets for international standards around home and host comparability, confidence, etc., free transactions across borders, and this essential issue around comparability? And I think you've got to look at the Solvency II experience again here, because actually, although Solvency II is a market-consistent regime, in practice there is still quite a lot of difference in the interpretation of market consistency between jurisdictions. And this crystallizes in particular around the discount rate, the UFR, where continental Europe has an extrapolated rate at the longer timescales, whereas the UK is taking a spot market rate in respect of longer durations. With the result that, as Andrew Bailey has pointed out to the TSC when he was chief executive of the PRA and my boss, it's still very difficult to make fully robust, meaningful comparisons between the solvency strengths of a UK insurer versus a continental insurer. So, I mean, I think you're right. It's founded upon essentially the same issue I was talking about in respect of Solvency II. There's this crucial issue of what is the valuation interest rate? How do you arrive at the discount rate? At the moment, the UK has one rate, Europe has another, the US has another. So the same contract would create very, very different solvency strengths between those three jurisdictions. And then separately, there is still really no consensus within IAS around the role of internal models. Now, internal models are a key part of the Solvency II architecture, huge sunk costs in internal models, and I would say very real benefits for firms and regulators from that. But still, this is to be clarified. So I think what issued from Kuala Lumpur was a compromise. I think the fact that it's attracted some criticism from all sides suggests that's probably like the best compromise in the circumstances. 5 years of private reporting with still these big issues around what is the valuation approach and what is the role of internal models still to be sorted out means it's really rather uncertain what this standard will ultimately look like. But at least we have a way forward on this. But I think it would be a very brave prediction to say that it's going to be a fully robust, meaningful standard at this stage.
Thank you. Jeremy, do you have a...
Yeah, I totally agree with Andrew on that. I mean, I think what is good about the ICS, whatever the outcomes, is that regulators get together and break down barriers. So I sit in the technical committee, and people start with different views, and they end up, oh, okay, we've seen each other's point of view, and oh, let's do it this way. So there's a slow coming together of people with very different views, particularly about fair value accounting, both assets and liabilities. And so that's very encouraging. So Kuala Lumpur said the show is still on the road, more road testing. But to put it in straightforward terms, imagine this. Imagine you have a big global international insurance firm sitting in New York, and imagine you have exactly the same firm sitting in Frankfurt. the capital requirement for the New York is X million dollars, and the one in Frankfurt is Y million dollars. We don't know yet. They certainly won't be the same. There's no question of that. They will be different. The question is, how far can they be apart? So can it be 10% apart, 20% apart, 50% apart, both in real time and on an ongoing basis? And that's really a policy decision, which I think people have not yet got their head around. And in 5 years' time, that's the one that the policymakers and indeed the politicians will have to make a call on.
Thank you. So looking now at the actual regulators themselves, how has international best practice developed in this area? Let's consider, for example, the Twin Peaks model, which separates prudential regulation from conduct and consumer protection. The international standards recognise that there are various regulatory models in operation around the world. So I'd like to ask whether you think the Twin Peaks regulatory model works for insurance supervision. Who wants to go first on that one?
So Jeremy and I sort of enjoy tweaking each other's tails on this. A few comments, if I may. I mean, firstly, I think it's a fascinating subject. I don't think there's an absolute right answer. And I would want to preface my comments by saying I think there are very strong arguments in both directions for whether we go for an integrated regulator or the Twin Peaks. There are conflicting arguments, conflicting considerations. And I think my comments also, must be related to the UK position. Don't want to wish to comment on the Guernsey situation. I think in practice this decision is very much jurisdiction specific and has to take account of the particular needs and characteristics of each jurisdiction. So all I can do is talk about my own experience. So, I mean, the UK's tried virtually every system now. We had self-regulation coupled with state regulation of key sectors for a while. We then had the integrated regulator in the form of the FSA. We now have a Twin Peaks regime. I mean, I think I was always struck by what Adair Turner said at the end of his term as chairman of the FSA, where he said, having gone through the worst of the crisis, his reflection was that it probably would have been better if the FSA had been structured around maybe an internal Twin Peaks. There was no doubt that it was being pulled in different directions by its joint conduct and prudential remits. And I think at various points in the cycle that there is always going to be a risk that one or other of those remits gets crowded out. Certainly that was the experience in the FSA during the crisis. I think a lot of conduct work had to be, of necessity, had to be put a little bit on the back burner while firms basically were in very severe stress. And I'm conscious also that our present system in the UK has not been stress tested in the way that the FSA very seriously was in 2007 through 2009. But I think as a former regulatory practitioner, what I think is one key benefit of the Twin Peaks regime is the clarity of role it provides. I think there's real, from a regulatory perspective at least, real operational benefit in having a clear prudential remit or a clear conduct remit. And I think that is useful. I mean, I recognise it can create an additional overhead for firms, but I think the quid pro quo is that it produces better quality regulation, more focused regulation potentially, and a better understanding of the firms themselves. Now, I think insurance is very interesting in this because I was involved in the planning of the PRO. I was on the original working group set up to plan it once the government announced its intention to go down this route. And it's interesting, the insurance was the area where most debate occurred because there is clearly a potential trade-off between consumer fairness issues and solvency issues, particularly in products such as with profits and one or two others. And there's no doubt that in the FSA we took, and I would say very appropriately, some quite difficult trade-off judgments between those two things in a severe crisis scenario. And I think that's probably the untested part from an insurance perspective of the UK Twin Peaks regime, that there is a complicated architecture of memorandum of understanding, of information exchanges, and asking for determinations of fairness, albeit with an overriding prudential override, if you like, in extreme circumstances. So I think that's the unproven bit. But I think I have to say, from an operational point of view, there is an enormous benefit in having clarity of prudential remit, clarity of conduct. I think there are potentially different skill sets involved as well, which that recognises.
Thank you.
I can sort of, just interrupt me, I can sort of see that from the regulator's end. I have to say, you know, from a practitioner's end, you want to deal with people consistently, you know, people that you get to know. You want to get one answer and know that that is the answer. And I think, you know, in a previous session, it was, you know, a very good example was given where actually from a prudential perspective, the regulator wanted to see the firm doing one thing, and from the conduct perspective, I think the quote was, they absolutely hated it. And that sort of situation from an industry perspective is unacceptable. You know, in industry, you need to know either you've got permission to proceed or you haven't got permission to proceed. Sure. And the other worry is, fine, you can do Twin Peaks if you're big enough. Oh, okay, so you want to do Twin Peaks, so what, that's more, you know, it's a bigger levy on the industry, is it? Question mark, you know. So I agree with what Andrew said in terms of, look, this is very much jurisdiction specific.
Jeremy?
Yeah, well, I slightly disagree. I mean, I would say, though, that I do think that banking prudential regulation and insurance prudential regulation had best sit with the central bank for macroeconomic reasons, which is an aside point. But and I can see that there are similarities between a conduct and a prudential regulator. It's not all disagreements, but as Andrew said, fundamentally there are some tensions. And as a unitary regulator, I sit and I feel those tensions from both sides. But it seems to me just more efficient, both for the industry and for the regulator, to solve those tensions within one institution. Because otherwise you get a clash of the titans. You get the conduct regulator battling with the prudential regulator. And yeah, you may get the right result, but then you've got all sorts of political issues and credibility issues, and you know, and it just becomes political, really. So in a perfect world, and I can see there are all sorts of political and institutional problems and operational problems about having a single regulator, but I think that would be the best solution. Resolve the tensions internally rather than politically.
Thank you. Do we have any comments from the audience on any of those comments? No? Okay. Perhaps then we can move on to the discussion around the innovation and technological aspects of the sector. What do the panel think are the main technological disruptors to current insurance business models, and how might they change the current models? Andy, I think you have some thoughts on that.
You know, when I was invited to come on this panel, I probably would have said, you know, there's a lot of hype around, but, you know, the current, you know, major players will dominate, and actually a lot of it is overhyped. But, you know, the more I've sort of researched stuff in the last couple of months, really, the more I've been struck about what is out there. And it's interesting, if you look at innovation in our industry, you might say, well, you've got the major players, there'll always be the major players, and they will just, you know, carry on with their current models. They will use innovation like they use IT today. IT strategy follows business strategy. But we know we've got, you know, pretty vibrant fintech, insurtech sub-industry at work, people who have a very different perspective on our industry. And then you've got what we call the big tech players, Amazon, Google, Tencent, Alibaba, you know, people who view our industry completely differently. And one of the interesting things is they start from the consumer, and what need does the consumer have that's not being served? Let's be frank, you know, the insurance industry tends to start from, these are the products we've got, and who can we sell them to? Now, I know that's a little bit black and white, but I would say to you, I think that is, you know, the two starting perspectives. I think we have to be very careful that we do not underestimate the ability of firms outside of our sector to come in with a completely different approach to the way we do things. And interestingly, if you look at all of the major global insurers, Allianz, Generali, Zurich, you know, they are all either acquiring but actually by acquisition or getting heavily into bed with small fintechs. They are taking it very, very seriously. When it comes to things like saving, you've got people like Moolah, Wealthify, Monzon, who are looking at exploiting areas which, frankly, the traditional industry has moved on from. Can't make enough money out of those people. Young people, we'll wait for them to make some money and then we're interested in them. That is completely different to the attitude of, the tech giants and the fintech startups. So I think there's a lot going on. We must be careful not to think that, oh, that's just a fad and it won't have an effect. It really will. It will absolutely change things. I'm in the UK. I'm involved, as you said, in one of the big insurance firms, advisory firms, and I was talking to the CEO, and he said, "Andy, have a look at this app." And he got his mobile phone out, and he said, "Right, we'll take a selfie." Click, and it said this application said my age. So it could tell from looking at me how old I was. I'm glad it didn't say I looked older than I was. But it knew how old I was. And it estimated my BMI. And that was pretty close, because I know what my BMI is. And it said, we will insure you for £100,000 for this amount of money. Press the button to accept. Now, my firm sells a lot of mortgages in the UK. We're probably the UK's biggest mortgage broker. Getting people, having gone through perhaps a 3 or 4 hour interview around a mortgage, and then have to say, oh, and now we've got to get you insured, which is really, really important. A lot of people just lose interest. Now, if it's click, click, how's that for a price? Press the button. There's a lot more people going to be doing it. And the point is, if we don't do it, somebody else will. So that's sort of my caution.
Okay. And Jeremy, what do you see as the regulatory challenges from this evolving technology?
It's an absolutely huge issue. So the Director General has already written about social exclusion in the Guernsey press, which I think clearly is a bad thing. There is also the basing of underwriting on factors that care has to be taken about, genetic issues. There are a whole series of questions about privacy and the right of individuals to privacy. Also, I think from a regulatory and indeed a commercial point of view, insurers, new or old, have to both create underwriting assumptions on technical reserving on data. And regulators and boards make sure that data is accurate and can be verifiable and make sense. The sort of example you just gave us, which I totally agree is out there, does that tick any of those boxes? And you've gleaned it possibly from Facebook. So who verifies that every entry on Facebook is correct? I think from a commercial point of view, I could see insurers going down that road and, frankly, making a lot of mistakes. And that would concern a regulator. I think a regulator would say, so on what basis, how have you priced this product? How are you reserving for it? How does it work? Those are questions I think that would be uppermost. So those are the negative sides of all this. But there are, I totally agree, a positive side. Yeah, it could shake up the traditional insurance industry. I think people, my own view is that people are underinsured, generally on general insurance, and this could be a good way of providing cheap and effective insurance for people that easily on their iPhone, that they could just say, yeah, I need that, woomph, there it is. So I think that's very positive for everyone. And also, big data isn't necessarily bad. For example, what always occurs to me is the 20-year-old person who is deemed by currently insurers to be, almost uninsurable. But in fact, if you looked on Facebook, his most exciting activity is to play bridge. And you think, well, perhaps we might insure him for a reasonable amount. So people who are excluded from insurance could possibly get decent rates the more it's made bespoke. So it's it's a huge issue, and I think one that's going to preoccupy us for some time.
Andrew, do you want to add something?
Yeah, no, I agree with all that's been said on this, really. I think regulators do see technology as, in many ways, a benevolent force. And I think for instance, reference was made earlier to the advice gap and the way robo-advice could, against a background of pension freedoms, auto-enrollment, etc., could provide modest portfolios with that sort of key advice input that they haven't got at the moment. There's clearly issues around privacy. GDPR obviously is adding to the complexities there. I think from an insurance perspective, what I find particularly interesting is the potential for this, or some technologies, to almost to run counter to the neutralization principle of insurance. I think this is very interesting. I mean, insurance ultimately would take this room. We know that, unfortunately, one or two people in this room will eventually develop a serious illness, and we don't know which that's going to be. Therefore, we pool together our resources and we cover the persons who unfortunately suffer that illness. The way technology is in some ways cutting against that, or cutting through that towards individual underwriting, towards a very, very specific individual pricing of risk, almost pricing to perfection, could, in a very long term, I don't think it's imminent, but could in the longer term cut across that essential insurance principle. And I have to say, it sounds a bit textbooky, but ultimately, if we really can price this to perfection, then it sort of almost increases the argument for self-insurance.
Just one thing further, I think, just to, again, disturb us out of any sort of self-obsessed, well, this is our problem sort of attitude, is I think there are out there what I would call market chameleons, people who are currently in one market, not insurance, who may suddenly find themselves or want to position themselves in insurance. So let's look at the automotive industry. It's pretty well accepted that car makers do not make any money making cars. They make their money currently from financing the purchase of cars. Now, that's all very well if people want to buy and own their own car, but it's pretty well understood now that younger people, millennials, actually are not that keen on owning cars. They want access to a car, they want to use a car, but they don't necessarily want to own it. They want to share, perhaps, the ownership of a car. How do we insure a car that's shared owned? And how about autonomous vehicles? So when you've got a car driving itself, and this is going to be here, I'm not sure about Guernsey, personally, with those granite curbs, but anyway, they're going to be in the UK. Even the UK government is saying within 5 years there will be autonomous vehicles on the road. And the way those cars behave is going to be programmed. So who programs them, how that car's going to behave when one person steps out in front of them? Well, presumably it will brake, and if it can't brake, it will go up on to, take a different course. What happens if there's one person stepping out in the road and there's 5 people on the pavement? Does the car go up on the pavement, or does it hit the person on the road? It's not better called programming consideration. Who is going to insure a car that is going to knock over the one person but not the 5? And who actually makes the choice about how that car is programmed? Are you going to go into a garage in the future and car showroom and say, oh, I want the one with the metallic grey and the sporty wheels, and I want the car that does this in the event of an accident, or it does that in the event of an accident? Is that going to be an optional extra when you go and purchase your car? And so who's then going to insure that car? Is it going to be an insurance company, or is it actually going to be the car manufacturer? Perhaps they'll say, well, it's our car, we do the programming, we're going to insure it. So these things, we must be careful that we don't think that we're in charge of all this. Other innovations in other parts of industry will drive insurance risks, and we either respond, we react, or we get in the van and work out what the solutions are.
Yeah. And I'd add to that. I mean, if you believe in the total laissez-faire, then fine, we'll just see what's going to happen. But if you look at banking, for example, open banking is being done in a systematic way in the UK. The APIs will be regulated by the FCA. The data that will be being handed over are your bank accounts, so that's pretty solid data. But when I look at the insurance world, there's nothing like that. That all this data mining is, we can do it now with Google. I mean, no one's really controlling it. When you talk to regulators about social exclusion, they tend to say, well, it's a government problem, not really our problem. Similarly, whereas Basel has produced really quite a long paper and a very interesting one on open banking and the Second Payments Directive and so on, generally there's not much that the regulators have produced that will start answering these questions. But these, of course, questions are going to come at them very, very fast. But as ever, it may be that regulators will be so far behind the curve, just be picking up the pieces. So I think we do need to think more about it.
Okay.
Just say one brief word on the exclusion issue, which I think is really, really important, and actually might be the regulator's way into all this, because there's no doubt that a lot of this does bear on wider governmental and social policy, and I think saying where regulation ends and where that begins is quite a difficult boundary to draw. But I think if you look at some trends in product regulation elsewhere, I think the FCA in particular is getting more and more interested in this whole cross-subsidisation issue. And I think to the extent these new technologies are producing cheaper ways of delivery and in ways which some groups of customers may be less comfortable utilising, then those groups of customers may be paying more for their traditional delivery mechanisms to the extent where they may be cross-subsidising. So I think, given that the FCA is looking at bank accounts in this regard, vis-a-vis whether their free banking is subsidising higher interest elsewhere, and renewals of GI premiums, another area of potential cross-subsidy between existing and new customers. I think the whole cross-subsidy focus will lead the regulators inexorably into this whole area.
Okay, thank you, panel, for your comments this afternoon. We have time for 1 or 2 questions from the audience, if you'd like to raise your hand, if anyone's got any questions for the panel.
Let me just be provoking to everybody that if you are a senior manager or a director of an insurance company, be you a primary insurer, be you a reinsurer, you cannot afford to ignore the innovation that's going on in fintech and insurtech. And if nothing else, do what I did and get on Google, have a look around, get on LinkedIn, find out what's going on, because one way or other, this is coming.
Thank you very much.
Thank you.
Thank you for listening. Thank you, Stephen.